Testing, we're live here. Second stream on a Monday. Let me make sure it's working. Let me make
Test,
sure it's working.
test,
Make sure it's working.
test.
Make sure it's working.
Okay.
We got audio. All right, as you know, I'm doing live streams once a week. The current time is 5 p.m. on Monday, EST. And I finished up last week. Uh, we finished up the general rental business and the modifications for the equipment rental um, and the old equipment rental models I had. I have updated all of those, the original ones and the new one with the new update that had what was it? Yeah, define the frequency for which items can be rented out. So that was good. Um, and so now I'm looking for something new to do. I did have one request on Twitter, but I can't actually remember what he gave me a abbreviated term, and I don't actually know what it was. So I'm not sure if he was talking about the rolling rent self storage model or what. But yeah, if you viewers, anyone out there, I'm open to suggestions on what you want me to build. I basically will model anything you want. You could see I've got over 100 templates here on Smart Helping. So until I get a suggestion, I'm going to look for potentially something to update, or maybe if I think of something new to do. I mean, the self-storage one was pretty good. It's pretty heavy into the real estate, but a rolling self-storage model, like where you do it, exit it, reinvest in more, and then kind of keep going, like on like 5 or 8 iterations, sounded interesting. I don't know a whole lot about self-storage though. Uh, don't forget to subscribe, by the way, to the YouTube channel. That helps. As far as Monday streaming, I do like it better than Tuesdays at 9 a.m. It's just I'm more awake, and um, however, Mondays are usually really busy, so I've had a pretty busy day. What I want to do with my profile picture here is update it with something that looks like this guy, where I'm on a computer like asleep. That's kind of funny. So stand by for that. Who knows what I might do. Um, so what to do? What to do? So so if I did a self storage, if we just think about it, um, obviously you have to buy or acquire. Let's just talk it out here. You have to buy or acquire a plot area, develop it, and then you start renting out units. People pay you money per month to rent out the units as long as they're occupied. There's probably some uh, occupancy. Now the thing with that is the costs I feel like are pretty low with self-storage as far as operating costs. You probably have to pay property taxes, uh, general maintenance on the storage units, but that's probably pretty low. trying to think. Develop it. Yep. Or you could buy an existing one. Rent it out. I mean, it's pretty simple. We can go and Google. Let's go to Google and see just some general operating a self-storage, starting self-storage business. Typically, essentially makes probably 67% of full occupancy. Currently, industry average occupancy at near 90%. That's pretty good. How much does it cost to own? On average, a single story storage facility is $25 to $45 a square foot to build, while a multi-story costs 42 to 70 per square foot. Okay, so that could just be a function of the total square feet and the total units. Um, if it's obviously it could cost more if you got more units per square foot, or yeah, more units. A higher end storage unit facility has 60 to 80,000 rentable square feet and costs 45 to 65 on construction. Okay, that sounds pretty good. The cost of land is always one of the biggest costs. Note that you'll be using about 40% of the land purchased for your unit, for your storage unit. So the net cost of land can also be booked at around $6.82 per net rentable. And I don't really care about the actual numbers right here. I just care about what logic needs to be built, the math for it. Uh, Obviously, the cost per construction varies. I have marketing costs, 68% of revenue. Interesting. We could do a percentage of revenue for like some of the Opex. That's pretty easy and it scales nice. Operating expenses $2 to $3 a square foot. Good legal, real estate, obviously. So storage unit expenses range from two. We could probably put. I would rather hard code in um, the taxes and salaries, and then that'll just be and then we could actually back into this number. All right, pretty good. I think we got a model here. So we're gonna do self storage. Here's the source. We'll have revenue assumptions here. Now we're probably going to have to build in variability for acquisition versus development. Revenue assumptions, expense assumptions. We also have to think about how we want to roll how the investment's going to work. Like, I don't want to treat it as, you almost want to treat each deal as its own waterfall. Like, you borrow money or you get money financed from investors at some preferred return. you run the first storage, you get it profitable, you sell it, pay back the investor, and then you take the proceeds and then you go do another one and another one, a different deal, new investor, new terms. Now we could try to do like 5 or 6 rounds of that. Probably not more than that. Like 5 or 6 waterfalls is probably good. Um, I think it would be interesting to do that. So really the logic here that's cool is the rolling of different um, multiple self-storage facilities and exiting of them, and then see what this looks like for the actual owner over time. And then you'd also have investor payouts over time. So I think that's pretty good. Uh, let's think about this. This is almost going to be like a database style, like the mobile home park one I did a while back. Okay, we don't need any of this. This is a good source. All right, so let's just start organizing this. We got self-storage, development. It's almost going to be like fund one. So this fund is going to do some stuff, and then it's going to exit. Um, Obviously, at the exit, there's payoffs for the investors and the owners, and then the owner can then go invest that into a new deal and do like a bunch of those over time. So we're definitely going to have to do this on a monthly basis and then roll that up to annual. I'm trying to figure out how we want to define the cost to develop and run and exit in a super, like a not too granular, but high enough level to do a quick analysis here. Let's see. Let's just do development costs. Land. First of all, let's see how many, what do we want to do here? We'll do total square foot, total square feet, rentable square feet. So let's say whatever, like a 80,000 square foot. And once we get the assumptions for one of these self-storage units, we can go, we got a good format going forward. We'll say like percent rentable. What are these guys saying? I think 80%. 45%. So if I go and buy, oh, I gotta save. Shoot. So if I go and buy a self-storage unit or develop one, I gotta know the square foot roughly. $6.82 per net leasable square foot, which is this. So cost of land as percentage as dollar per rentable square foot. So that's going to be a dollar value. Let's just say $7. I think is close. 682. So if you can rent out 36,000 square feet, it's going to cost you about 245,000 in land, roughly. And obviously, these are rough numbers. You could put in your own numbers to make it fit whatever you're planning to do. Um, cost of land. Land, and then you've got construction. So it's hard to estimate depending on the actual landscape of the site. Normal development of site costs between $4 and $8 a square foot. So they're saying, I'm trying to see, is this $4 to $8 per square foot of, this is a variable cost, depending on the actual landscape of the site. Normal development is of site cost between $4 and $8 a square foot. Is that square foot of the site or square foot of what's actually being used to rent out? So it's all depends on how much digging, clearing, draining is required on the land. On average, a single-story storage facility costs $25 to $45 per square foot to build. While a multi-story costs 42 to 70 square foot for construction. A high-end storage facility has 68,000 square feet, costs 45. All right, so screw the square. Hey, we got some viewers here. Guys, we're trying to do self-storage here, and it's going to be a rolling fund for somebody who like buys or develops a self-storage unit with a fund, run it, exit it, and then the owner can take that cash and go do another one, and it's supposed to show like 5 or 6 iterations of doing that, and it's going to have waterfalls for each of the 5 or 6 tranches of doing it. And right now I'm trying to figure out the best way to structure the acquisition and development. And here I'm trying to figure out what they're saying here. I think we're just going to do a hard coded. So cost of land is fine. That can be cost per square foot. But I think we'll do construction costs, whatever. You can list out all the things if you want, but essentially it's just going to be like this. 10 items or whatever, and you can have the total cost. Because it's going to be vary from deal to deal. Let's just say, let's see, they're saying 25 times 36,000. Okay, so yeah, about a million. So construction costs, and then you could have this add up to all of these if you want to parse it out. So we've got the land, we've got construction. So we go to buy or acquire, you got this and this. If it's not, now see, you've also got to deal with, are you getting money from a bank? We're going to assume no on that because that's just, I mean, it's just going to get way too in the weeds, I believe. What? Oh. So this is going to be assumed all equity, like either equity from the owners or from investors, but we're not doing any loans because then you've got to do. I've got other models that already do dynamic structures that are kind of like this and they also involve financing, refinancing, and all that. We're not doing that for this model though. So, and then we'll do potentially zoom out a little bit. So fund one, we'll do like 5 or 6 funds. This is going to be, if it's an existing self-storage facility, you do current annual net operating income. Let's say they're doing 200,000 a year in profit. Cap rate you want to buy into, let's say a 5%, or no, let's say a 6% cap. So then you've got purchase price is at 3 million, and that means in, let's see, 6%, about 16 years you'll pay yourself back in that case. So making 200, that's all cap rate means essentially is what price, or at what price, um, how many years is it going to take and this annual income to pay yourself back. And so 6% would mean 16 years. If it was 5%, it'd be 20 years. And all that means is, then the construction or so acquisition cost. So then you're looking at 4 million, meaning in 20 years you'll pay yourself back. So development, construction. So you've got land, build it. We've got a thick bottom here. If you want to acquire, obviously you're not going to do both of these. They're mutually exclusive. So if you're doing acquisition, then you're doing this. Now it's going to assume we're doing what, I guess each fund is going to be a single self-storage projection. So let's do a control tab here. So control, I like to put global assumptions. So start year of fund one. We'll run this so it's a bunch of funds. We could probably go to maybe 10 or 15 years. Probably 10 years is common. So let's say we're starting at 1/1/2022. I'll do some validation here for our drop downs to get the right months. And what I want, the goal of this tool is going to be something that's kind of quick and easy to use, and to where you can take, maybe if you have more granular stuff, you can plug the high level that into here as a high level. 2, 3, so we need to go to 31. What's going on, viewers? We're doing self-storage model. It's going to be a rolling fund. We've actually never done that before. This is consent and purchase. Okay, so here we've got start of construction is a date. We're going to assume all of these costs are going to be required right up front, and we're assuming there's no bank loans. This is all either equity from investors and owners or just investors, but it's going to involve no bank loan debt, refi, none of that. It's just all equity. Start of construction date. And you could, I guess, plan this, like this could technically be more than one if you're saying it's all happening on like the same date. So I could be like, this could be 4 or 5 self-storage um, plots that are being built. Um, all we're trying to figure out here is the cost on this date. All right, so we got start of construction, length, construction lasts in months, and then revenue start. And I guess development purchase. Always thinking about how to structure these things. Say like 6 months. And then, so fund one. You know what? I wonder if we can just drag this 2, 3, 4, 5, 6. We can just assume there's going to be 6 here. Fund one. And these will be the editable ones. And the key, I mean, so this will have breakdowns for cash flow to investors and owners, but the key is the owner wants to see how much money they need to actually, how they can build up as they exit these things. I think that actually is very interesting to figure out how much actual cash do you need and how can you scale, how big can you get, how long does it take. We could put, just have leave these hard coded, but just put like, so May, July, August, just random dates in here. Okay. All right, I like this so far. I feel like we're self-storage development rolling fund. Why don't we just make this a broad? We could lock all this. So let's just review some of these assumptions. We got the start of construction when revenue begins. We're going to have to do occupancy and occupancy improvement, and then stabilization, maximum occupancy at stabilization, development, units, total square feet, percent rentable, cost of land, dollar per rentable square foot. Let's make this a little bit wider. Construction, total all-in equity required. Oh, we probably want to put like a reserve in here. And we're going to assume that's going to be used when we do the cash flow. Say like 250. Just looking here. Do we have any other? And again, this I'm not really using for the numbers. I'm using this source as just to understand what logic needs to be in here. So we've got development costs, construction, marketing, and then Opex. We're just going to put well, I mean that kind of is the dollar per square rentable foot or dollar per gross square foot of the facility is kind of nice because then you take the instead of defining, well, I don't know. It's hard because you've got property taxes, salaries. These could change. These could vary a lot. So if you just do this, so I guess it's good at a high level. I think it's good at a high level. So OpEx, we're just gonna do dollar per gross square foot. I like that. Uh, so all in equity we're gonna need is this. And these are, again, mutually exclusive acquisition cost versus construction. So if somebody were actually doing this, they would only fill out one or the other. So if I go, I'm going to do a self-storage fund. Here's my startup cost. Here's how much equity I need each time. Now the key is how you structure the waterfalls. And we're going to have to pull in, probably the pref equity one is the best, which I've already got built here. So this model is going to be the best. And it does almost like a mezzanine debt and then waterfall after, but I'm just going to use the waterfall, the traditional waterfall. So all this logic is self-contained here. If you want this out, it's available at smarthelping.com. Let's just get this in here because I know I'm going to need it. B2. Freeze these. And these numbers, we don't know any of these numbers yet, but so waterfall, we'll probably do cash flow 1. It'll be cash flow 1 through fund 6. Um, I'm actually very interested to see how this plays out. We can probably do all this on the same assumption tab, develop, so let's just put assumptions. And with these, it's almost like the easier, the more simple, the better, because you just want to be able to plug in some numbers. That's why that dollar per rentable square foot for Opex is really good. You just run down the line here on the same tab. So this is all in equity required. We'll do, next up I want to do Opex. And this is going to be defined as, we'll just do, so these again are going to be different than like a traditional business where you kind of grow expenses because there's a lot of different reasons. But for here, your OPEX is just going to be a number and then it's going to go up by some percentage every year. So annual, what was this? Operating expense, $2.75, $3.25 per square foot. I'm assuming that's per year. See, they don't even say operating expenses range from $2 to $3 per square foot of the facility. I'm just going to assume that's per year. So operating expenses, cost per square foot of the facility per year. And that facility square footage would be essentially what you're renting out, which is this. We'll make these all the same for now. Doesn't really matter. And also I did a wrong color here. That needs to be bluer. I'm red-green colorblind, by the way. So sometimes it's hard with different shades. Okay, I think I got them all. Okay. Rolling fund. Equity only. Say it's $4 cost per square foot of the facility per year. And then annual percentage in Opex. That will not really vary at all. So whenever it starts, the percentage will just be the same, whatever it is. Let's just say, 1%. Trying to make this look really clean. This development, serve. So then based on that, whenever the month is that revenue starts, from then on, every 12th month it's going to go up by 1%, which we can do elsewhere. So we'll do a matrix here. We've got each fund. And then there's a bunch of ways to do this, but I just like to do so we know we'll have to know the age of each fund when revenue started. We're not doing that here though. And then we have this. We'll have this through 120 months. And all we need to know is where we're at. Um, let's see. So we go 0 to 13. So 0 to 13, the first one's going to be nothing. It'll be whatever it is at the beginning. And then, let's see, this will be whatever we mark in. Well, these are different for each one. Hold on, let's think about this. We want to know at a given month in the life of a fund, what are the Opex expenses if they go up 1% per year? Well, this is the same. This is not going to be variables. This is 1% for each fund. It doesn't matter. So we don't need this. So 0, 13 through 121. So we're going to go, the first one will be 1% more. And then this will be 1% of that. And here's how we do it real simple. Watch this. So 0. So if we start at 100, or no, sorry, if we start at a base of 1, we go 1 times 0% plus 1. So we're a factor of 1 on the first. After the first year, we then go this times 1% plus this. And then this is our factor. And we just reference and then we can just do a real simple one here. VLOOKUP the month, and we get the factor. There you go, simple. Now what we are going to have to figure out, did that work? Let me make sure, let me go out another decimal. So 12 and then 113, we're at 1% more, a little bit more, okay, good. So we have this is all hard-coded based on percentage, that's fine, simple. What we need to know now is when the life of each fund. So, and we're going to do it from the start month of revenue. And that's when Opex costs start. And then this period here is just when construction's happening. If it's acquisition, then you could just put 0 in and if you think you could start making revenue right off the bat, then more power to you. So matrix 1 is our growth of expense. We're actually going to have to do another one for revenues. I wonder if this talks about revenues. I don't think it does. Average revenue per self-storage. Figure that out. $40 a square foot. Okay, so we can put another slight, so construction. For this acquisition, so this is based on cap rate, but we could also do, um, we could put in the square feet and say based on the square footage, and based on this, what's the resulting price per square foot? I think those are important metrics to just have. So if this is 4 million, you're going about 114 a square foot. So that's good. Just that'll show you based on what your whatever your acquisition cost is. This is a nice resulting price per square foot. You can measure that against other things to see kind of how fair that is. What else are they saying here about self-storage? Any little details I can get are good to know what logic is required for these deals to be analyzed. Now, operating income 2 to 4 to 6, 8 per square foot is. So they're selling at a multiple of 10x the net operating income per square foot. So that's an interesting metric. Costs around $4 per square foot. Average self-storage facility sells for just under $40 per square foot. Net income, so all this stuff we want to have here. We'll do these as like key metrics. Net income per square foot is definitely a good one. For expenses around 1/3 collections for the. Yeah, that earning per square foot, that's going to be a big one too to figure out exit values. There's no generally accepted accounting principles or rules a seller cannot break in presenting income. Okay, interesting to know. Be careful there. Buyers will create different income statements for the same facility because of timing and operating differences. Buyers. Okay, whatever. I want to know. Um, we're trying to figure out revenue. I guess it'd be revenue per unit. Let's put per self-storage unit. Self-storage and average storage unit price. All right, $88. Average occupancy 92. Just to get some random numbers in here. So we want to do, so we haven't actually defined the units yet for this. We're kind of going backwards. We're going like construction, acquisition, development, reserve, and no, these are mutually exclusive. So if you fill in acquisition costs, you're obviously not going to be doing any. You might do some renovations, so I guess you could use some of this, but you probably won't be doing land purchase because it'd be included down here. But we got all that logic. So we're doing kind of the acquisition equity requirements, and then we're going into Opex, which we have here. I think we can define, we can use this schedule for each one to do that. So Opex is kind of done. Next, I guess we do revenue. So one, two. So for revenue, we'll do for each one you need, obviously, the total rentable units. Say, so that'll be a static number. We'll do starting occupancy, let's say, whatever, 75%. And then let's say occupancy improvement per month. Let's just say like 0.5. And then we'll say stabilized occupancy. And that means it'll go up 0.5% until it hits this number, and we'll just say 92. So that's the max. It could 400 units times 92% is the max monthly, and then based on the unit count or average revenue per unit. And what did they say? It was like $88, I think, per month. This needs to be currency. So it's all uniform. All right, let's really think about what are we missing here? Opex, square feet. I guess we could put a metric in here, average. If there's 400 units, $88 a unit at that many square feet, average or max revenue per square foot, which would be 36,000 is rentable divided by units. That's 90. So the average unit is 90 square feet. You times that by, wait, let's think about this. Average revenue per unit per month, $88. 400 units. The average square feet of a unit, so 400. am I trying to say here? Um, you got 400 rentable units. You've got 36,000 square feet. We want to figure out the average revenue per square foot. So I think we do square feet divided by rentable units 90. So the average unit is 90 square feet. And then we're getting revenue of, let's say the max revenue would be 88, be 35,000. So, oh, here we go. Max revenue divided by total or square feet. So we can make that much revenue with this much square feet. So 98 cents. Does that make sense? 98 cents times 36,000. So that's my monthly max revenue per square foot per month. And then per year, obviously it's just that times 12. And I believe that makes sense. And it's kind of nice to see as you're putting in assumptions what you're actually saying, which is this here. Max revenue per square foot per month, max revenue per square foot per year. $88. 36,000 square feet. Yeah, because you're making about 30,000 a month. You need 33,000. If this were to be like a 50,000, you're making $1.50 a month. And let's see, let's do the math here. Let's see what they say. Average revenue per square foot self-storage. $4 per square foot of income. Hold on, I want revenue though. That's net operating income. So we know our number. Okay, so if these are $2 to $4 to $6 per square foot of profit, again, is this annually? If it's annually, it makes sense because you take, let's say, 50% profit, 40% profit margin, you're at about $7. Okay. So I think I'm just making sure the math is right. Okay, so we've got average revenue. We'll put average percentage growth in revenue, which will just be a number just like Opex. Let's say revenue, you start charging more over time for inflation or what have you. I'll just put 1% for both of these. So we've got Opex, we've got all our revenue, we've got our cost to get into these things. I think that's, oh, we got to do one more matrix tab. So this is going to be to define the life that we're in within each one. So matrix 2, need this. We're going to go 10-year model, so 120 months. I'm actually very excited about the results of this thing, the ability to use it to plan out. So if this, oh wait, we have to do our start year. Leave space for a year two. So this is round up. So we got our months here. We're gonna need, actually we're gonna need months going down too. So if, no, shoot. We need, fund one, D, E, F, G, H, and I. So this is gonna be if this equals start month here, then 1, otherwise 0, and do the same thing. And then I love this logic string. I love doing this one. So you got that for the first one, and then we do if, put this ahead of it, if C4 is greater than 0, then C4 plus 1. So now you get a dynamic count. And actually we can't drag this down. We have to copy this since these are referencing different rows. And then we'll go, so this is fine. That comes over. This comes down. That goes up, down, up. Perfect. And we got our counts. There we go. So there's our schedule. One of many we're going to have to do probably. So we have monthly detail. And well, it's going to follow. I like to use the formats here. Let's pick one. This is fine. The mobile home park. This is one where I did dynamic revenue or loan and refi assumptions for every single acquisition. It's a lot of logic. This is a big file. Uh, all I want is the monthly detail right here. This is real simple. It's equals to this. This all drags. Okay, so we got, let's see how we're going to structure the monthly. Because really it's got to be separate, um, separate P&Ls. So each fund has to have its own separate kind of area. So let's do the first one. So it's going to be Fund 1. And we'll just start exactly as we do on the assumptions. So total equity required. And if this equals our start date, then pull this number, otherwise 0. And that might not necessarily always be in month 1, so drag it over so it's dynamic. I guess let's go all the way out. 120 months. $13. All right, so Fund 1 is there. Equity required. So that actually takes care of like all of this. We now go to, I'm not doing these opposite, so we have to do the revenue, occupancy, and all that before expenses. So let's do, um, let's see. Max unit count, max or unit count, occupancy. So it starts at 400 no matter what. Starting occupancy is going to be our 75%. Well, no, we got to go. So let's see. What do we do for matrices here? Got rent. If this equals 1, then revenue has started, so we'll take our units, otherwise 0. Okay, so unit count, occupancy is going to be, let's see, we may have to do a matrix for this too. So we go if this equals the start date of revenue, then do occupancy 75%. Otherwise, do the previous month plus whatever we're increasing our occupancy at. And then we're also saying if C2 is less than this, then 0. D7. We want to do D7, not D5. Lock, 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 lock. Okay. So this should give us a percent that starts to grow when revenue starts. There we go. And then we do a maximum of this value or the maximum defined here, 92. So it can never go above 92%. Wait, sorry. We do a minimum. So it'll never go above 92. Lock this. And now we get a nice scale up to 92, and then it stays there. Now, question here. Did we go into marketing? Did he, this other source, I forget if they listed marketing as part of the Opex or not. No, this is separate. Okay. So marketing, 6 to 8% of gross revenue. All right. Oh, where are we? Okay, so this is cool. It goes up to 92. It levels off. Perfect. Now let's do it for the next one. We got to lock C2. D7. We actually have to lock all these. And then, so now we want E. Everything that was in D now needs to be E for this. Oh, whoops. E, E. Can't really do a find and replace because there's other letters in these strings that are also like E or F. They're pretty common, so I just gotta do it like this. Okay, and these should start staggered based on those start months. So good. Let's do different so we know this is going up. We'll start 1% higher on these as well as this. So quick sanity check. All right. So 76, and then 177 for that. That's starting there, here. Okay, we're good. So there's the occupancy rates. So we go over to our monthly. So for fund one, unit count is going to be simply unit count. Oh, whoops. And then we gotta do if this is greater than 0, then just take this number. So I think it'll be easy once we do one all the way through from entry to exit and cash results. We'll be all set. So rentable, so this is, actually we can just hard reference the occupancy here. Rentable, um, actual rented units. Or leased units. Leased units is probably a better word. For self-storage. Okay. So 368 is the stabilized units leased. We now have, so what we will do here is max revenue. And actually we have to do the same thing we did with expenses with revenue. So we'll do a table over here. So this is revenue or expense growth. Revenue growth, and that's just going to be, we define it here, 1%. So same factor, but it could be different if you put in a different number. So this is one of the times when VLOOKUP is fine to use. Now, we go here, we say max revenue. We'll start with, what do we call it? Rev per unit as this, and we'll go VLOOKUP. Our month number within the life of this one, so we have to actually pick this. So this month number, comma, this here. And then we'll multiply that result times the rent, or the price, lease price per month. And then we're before this is even started revenue, so we got an error. We're gonna zero that out. Do this. So we start at 88. Now you could see so April of 2023 we should go up. And there you go, 1%, $88.88. By the end of 10 years, it's up to $96. That looks good. Um, so we've got max revenue, a simple calculation. Revenue per unit times unit count. I'll drag this over. Give this a border. Little shade. So that's max revenue. Then you've got occupancy and then actual rented units. And then you say gross lease revenue. I think they're leased or revenue, whatever the case is, there's a monthly fee you're paying for these storage units. Whatever, we'll just use rental since I've already been using it, it's fine. So actual rented units times the revenue. So, and then you could put loss to vacancy is simply the difference between these two. Okay, so we have revenue for Fund 1 for self-storage. We've got a nice, easy, scalable build-up for occupancy. We got growth in revenue. Now we have Opex. It's going to be really simple because we're scaling 6 different things. So we're going to do, we're going to do 2 things. Sales and marketing is going to be its own item, and then operating, so other operating expenses. Because we're doing it based on square foot or dollar per square foot. So this unit, the first fund is going to do 400 unit or 22,000 square foot self-storage place. And we got $4 a square foot per cost per year. So we're going to divide this by 12 to get the monthly. We also have Opex growth of that. And then what was the other thing? So percentage of gross revenue so we have to add this assumption in. Sales and marketing. Percentage of gross revenues. I think this is a good one to do as a percentage. It'll just scale with all the other things that are scaling revenue. It doesn't have to, this percentage will not apply because it's just already scaling. So we got, this will be real simple. This times that. So we can drag that over, and then Opex is going to be scaled, so we got to do a similar calculation to this. So we look up, we need the year, so C4 or the life of it, and then we need to multiply by this factor to get the right growth of the expenses. And then we're doing it times D44. So that's fine. This is going to go to only 2 columns, and this is going to go to 44. So 4, and then let's see, does it go? Now it should be increasing. Where's my lookup? Matrix. Oh, it's probably so small you can't see it. Let's do more decimals. No, it's not. It's not moving at all. All right. 204. March, or so April 2023 should be. There we go, 404. Okay, I hadn't gone over far enough. So that's the cost basis per square foot for Opex. So we just take that times total square feet. It's going to be that. So the facility is 22,500. We're going to say there's some cost per square foot for all Opex. We just do that times square foot. And then that's per year, so we have to divide this by 12. And we got to do it at the right place, so we're probably going to want to do it. Let's just make sure we get the right number. So it should be 7,500. Perfect. Okay. And then you can see that scales with 1% per year. And the square footage won't change. It's the same facility. Sales and marketing is going up as the revenue is going up. So we've got total overhead. So that. This could probably be bolded. This can probably be bolded. Oh, here. And then we have net operating. And then we just do that a bunch more times. Now the tricky part is going to be into the distribution waterfalls. When we get to that, let's give this a nice format here. So equity required. Then we start operating here. Unit count, revenue per unit starts to rise. Occupancy, actual rented units. So this 88, let's make sure that's rented per month, right? Yes. Average revenue per unit per month. So that's good. This is good. I guess we go to exit assumptions. So we go revenue, exit assumptions. So this is, we got no debt. It's just all equity. So we could do exit cap rate. Well, no, exit month, exit cap rate, and then where's that key metric? Resulting sale price per square foot. And that's per rentable square foot, I'm pretty sure. No, that's for, what is this? Hold on, what's the 70,000 here? Oh, that's if you're purchasing an existing one. Okay, that doesn't matter. So we don't care about this. Well, hold on. So if it's an existing one, we would zero out. Let's just do this. The easiest way is to zero these out and just make it an existing one and see what assumptions we're missing now. So if it's an existing self-storage purchase, um, square, shoot, facility square foot, 70,000. Self-storage. Let me see what they're saying exactly. No, yeah, that's definitely based on square foot of the facility. So if we zero that out, what do we have here? Unit count. This still is fine because we have all of this. Rentable square feet. So 70,000 is got to be, so this has to be the main, if we're doing only purchase of existing, this has to be the driver of the square footage for all the calculations. So we'll go down here, let's basis for square feet. So we'll just do the max value because they can't both be populated. It has to be one or the other. So one's either 0, one's a number. So we just do max value between this one and this. So here's our actual basis. So any calculation that references rentable square feet needs to reference that, which would be this here for sure. Not this. And then it goes back to 36. Wait. we'll zero this out too to show what happens on the other side if this is no value. So that looks good. What else references square foot? So 68, whatever is referencing 13. Anything referencing 13. 13, this did. So that needs to be 68. Anything else? 13, 13. I thought, wait, what's Opex doing? D44. What's D44? Cost per square foot. Okay, so we're, I referenced it here. Okay, perfect. We're doing a self-storage rolling fund model here. All equity, no debt. And just checking the calculations on the first one. All right, I think this is fine. There's no other references to 13. No. All right, so we've scaled out revenue dynamically. We've scaled out expenses. Got all this logic. Got everything set up. So we want exit assumptions next. So let's pull this over here. You can define the exit month for each of these. Let's just say we can make it real easy. This template is going to be about ease of use. So months held for. So once you start it, we'll do, could be up to 120. We'll say we're going to hold them each for 60 months. And now this can be a dynamic calculation for the date of exit. And we're going to go 60 months from when revenue starts, which may or may not be the same month as purchase, depends. D62. Don't need data validation on that. So exit month. I still like doing the cap rate for the basis for the exit value, just because it's a self-storage is a common real estate thing. So we can do annualized net operating income at exit month. Really simple. Just do an index on, we'll just have the first one for right now. Index this, comma, match exit month with this. So 7,800 a month. Make sure that makes sense. 78, yep, 27, year 2027 times 12. Annualized net operating income 93,000, and then we just do that whole thing divided by the cap rate to get the exit value. And actually, then we got to do, these will all be different once we do the net, get down to NOI for the rest. So that resulting, so square foot, so this divided by this. So you bought in for $57 a square foot. You sold for $26 a square foot. Now, obviously, these assumptions are made up. What if the initial rent was like 350,000 or whatever? These numbers will, once you go put them in for your own strategy planning, you'll put in your own numbers. Key is that logic works when you put it in. That's what I'm here for. All right. Where are we at now? Um, all right, so exit value will go here. Oh, we also have to zero this out, so oh, let's get over to the first month. If this is greater than the exit date, then 0. And I believe I'll have to do it for the total square foot or the unit count differently. Okay, which one was that? Well, we'll know in a second here. All right, let's try to drag this over, make sure all numbers are the same, and make sure these all end at the same time. Perfect. April 2027, we are out. So we have exit proceeds, and we'll do net exit proceeds. And with that, what I mean is you might have some selling fees. So let's say selling other fees, net exit proceeds. Say it's maybe 7%. So really, you get 1.8 million times 1 minus D67. And then that's the number we want. So if this equals this, then take this number, otherwise 0. All right, we now basically have a basis for cash flow. And now the question is, how do we aggregate all this, which is going to be the fun part. Make sure this populated right. Perfect. 0.7. Just checking some of the calcs here. I think we're pretty good. We'll have to remember to finish this for the rest of them. I'm not going to finish the model today, but I'm going to try and get at least one of the funds done. So, exit. So now we have a cash flow, which is going to be this plus this and this. And then that's all dynamic based on the start months here. Like if we made that further out. Bold these, underline them. The main items, Opex, revenue, exit. Development, construction. These probably don't need to be bold. Unbold that. This can be just a light gray, but we'll do bold. I think this is a import number. Just so we can make sure when we do this, it matches. Okay, that's a bit easier to follow, I think. All right. Drag this all the way over. Now, we could simply just drop this cash flow into any kind of working model for Waterfall and see, but so the tricky thing is we're going to have a timeline of 120 months here, but the waterfall needs to be reset essentially at the beginning of each one. So some of the waterfalls, like if you started one of these future funds in like 3 years from the start date, Well, well, actually, I think this will handle it fine because we have it just won't be year zero that the money comes out unless yeah, it'll have to be based on year one because these are going to be rolling over time. And if we do it, oh, if we make the, well, if we make year zero the acquisition cost or purchase cost or development cost, but then we sum up the cash flows based on it being based on the timing of this, it doesn't make sense. So I think actually we have to do a matrix. This will be fine. Actually, what we'll do is go here and just do round up 12 divided by this. And then you just have, you can use this as the basis for, I think, oh, we got to go the other way, C4 divided by 12. And then you sum up the cash flows based on the timing of this. So then you're always at, so then, and then you could do, so for this cost here, we can just simply go equals um, negative or equals negative, and then this is always going to be the startup cost, whatever this number is. Um, these first percentages will define, let's make these the right color. I think that's the right, let's see, yeah. So this is going to define the amount of equity contributed for the LP and GP and the return. So it's essentially going to be pari passu. So it's a soft pref. Um, now the hard pref you could do by setting. Actually, yeah, you could set. Okay, we'll do actually a separate. So this is going to be. This is the reward contribution. So if it was a hard pref, you could say the LP gets 100%. And the GP gets none up until this hurdle, and then that's a hard pref. And then that might be different than the equity contributions. It might not be though. Like if the GP might be giving something, but the LP still gets all the money back first. Or the LP could still give all the money and GP doesn't give anything, but they can still get 10% of the returns, while the LP gets 90% of the returns up until 10%, and then it goes to the new cash split. But we're going to make the contributions editable. Or, yeah, different, potentially. So let's say it's, say 80%. So now we do this is actually not going to equal that. It's going to equal this. And let's make sure this is right. So that's the equity contribution. They're still getting, let's see, that's based on that. Always editing these things can be tricky. Yes, because I want the distributions to be different from the contributions. Now let's make sure. Let's see. Then this guy's going to get, that's fine. But their contribution is actually going to be this number. So we need 725. We got 5.8 from the LP. 1.4 from the GP. And for this, we just simply do, there's no way there'll be negative cash flows in after operations start in this. Well, I guess, okay, so we could do sum ifs, sum if the cash flow, well, no, because this is going to be potentially in here. This is running at a burn though at first for a while. How do we deal with this? Because I don't want to include the, oh, I guess I could just do net operating income. So we'll sum if the net operating income is less than 0, is less than, and here's the key. Now we go to the matrix tab to figure out the year. And if this year equals the year. And now, so there's the burn, and then here we just simply do the same thing, but instead we're going to sum up if it's greater than 0. And I think we can sum up the cash flow here because it's just adding the exit proceeds. So any positive cash flow there. And what cell is that? 26. Okay. And the exit is, why is that? I thought that was larger. Oh, I changed around some of the numbers. What did I change here that was so different? Let's see, annual NOI is annual NOI is 287,000. Cap rate of 5. No, this is not. This is the exit cap, exit value based on exit cap rate. And why? What did I lower? Oh, I think I made this 7. Wasn't it like 88? Wow, that was a big difference. So you can see 70 versus 88, 400 units difference of 267,000 versus 1.7. Anyway, here we are. And so so this is year 6 of Fund 1. And if we started this fund in like way out here in like year 3 or 4, it would end in like, 7 or 8, however, whenever I stopped it. And this would be based on the timeline of the fund, but you can still see the overall what's happening on the same timeline on this model tab. So that's kind of cool. Let's make sure. So this doesn't look right. Probably because this needs to be the same. Nope. So this check is an issue. What happened here? Assuming it has to do with am I referencing anything from a different model? No. That's all the cash flow. Oh, because it's negative. All right, hold on. Let's go. So this is obviously, you would never do a deal like this. Let's change this to, now let's look. Okay, there we go. So we got a positive internal rate of return. That let's make sure this works. If this is different, it looks like it's fine. We still check right. It's just the contribution to 80%, distribution's 90. That doesn't seem like it's presenting any problems. So you can see 80-20 on contributions, 90-10 on distributions. Tier 2, we have to adjust this back to the contribution. Distribution is fine. That's the new split. Now, where are general partner contributions? For example, what if this was like negative 50,000? Oh, here it is. Right here. Add contribution. So this, oh yeah, that's for a limited partner. Wait, what about for the general partner? Hold on, this should not be negative. All right, so maybe there is an issue with this. So if this is 90-10, I'm sure it works fine. Yeah, it works fine there. But if it's 80, we have an issue because, let's see, distribution. So 22 based on that. Oh shoot, it's already over 2 hours on the stream. All right, this is definitely a problem. I'm thinking it's because contributions are different than the distributions. So it's throwing everything out of whack, but I'm trying to see where we can correct that. Probably right here. So distributions are at 80, and then let's just add this up. So it's trying to distribute 27, but there's only 24. And oh, here's exactly why. Distribution 90%, contribution 20. So we know this has to be 90 based on, and then whatever you've contributed, which is 600,000. So there's your pref, which is not enough to cover. So this goes up by the difference. That's fine. Works out fine here, but here is trying to give, the model is trying to do 20% instead of, but it's, see, distribution 90. So this has to come down here. I believe that does it. 24,991. Perfect. Yep. And so the model was just assuming the contributions and distributions were pari passu, so it was doing those two, but really it should have been doing the available cash to split. Let's see, what G20, the available cash that's needed to be split but divided by 90% gives you the total. So it's giving you, backing into this number times C28, which is the amount for the GP. And then if it's an error, which the error would be if you zero out the GP or the LP completely, then just do this percentage times the amount. I don't know why you would that, but it essentially said if this is 0%, you now can do, you get the same, essentially the same cash flow for general partner as the whole project. All right, making sure this works for this. It looks like it's fine. Okay, so a little bit of an adjustment here on the waterfall, which is good to know. And it looks right now. Let's see. Do we got to fix this on the second one, general partner? So now it's going 25. I think that makes sense. 3070. That just needs to add up to 100% every time it does it. So that is working. And I like that we can change these so it's not, it doesn't have to be pari passu, but it could be. And if it is, then just make these the same. If not, then you can make them different. Why are these not checking? $750, $675. Oh wait, what happened here? $750. Um, 675. Where's this number coming from? Right here. Right, that's 90% of that, and then the other 75,000 should be from the. Oh, hold on. So this is 80%. 6, 6. So this one, ah, we need to adjust this over to here to 80. Add contributions. Make sure we do that to all these. That's 80 already. This is 80. Okay, now we check. Check, check. Good. That's why we have our checks. So the idea is you do as an investor, or the sponsor, you put in 150, you get some cash flows, you exit at some point in the future, and now what's going to be tricky, oh dear. So we exit year 6 in the life of this, but these cash flows are now on a different timeline than this. You know what I mean? Like, that's kind of tricky because we want to see when is the sponsor actually getting these cash flows in relation regards to the timeline here. I guess we could put this on an annual basis. Put the monthly on an annual basis and sum up these values based on, I guess so this is crazy. So this matrix is going to be how we cross over between the waterfall and the monthly detail. So when we want to go back to the monthly detail, we will sum up the waterfall based on these years in the cash flow matching this and how that correlates to this timeline. So technically, we would sum up, how would we do that? So if we put it on an annual basis, we'd have one being here, and that would actually be on the model be part of year 1 and 2. I don't know, that's going to be tricky. But we definitely want to figure out, because the whole point is we've got this nice waterfall and we've got the assumptions, but we want to see how each fund is doing and how the owner's cash flow is looking from on the same timeline here. But outside of that timeline, the investors are going to want to know their like year 1 through 10, which is here. And these years are going to be different than the model years, depending on the start month. So we have a little trickery here we got to figure out how we're going to go back, because I want to see monthly. We're going to have to put an annual here. All right, well, that's enough for today. Self-storage. We'll update the exit value for all these. We'll build. So next time we'll do fund 1 or 2 through 6. We'll get the annual detail done for that. Actually, I shouldn't even do this annual detail until those are done. So we'll finish the monthly, do the annual. We'll do the cash flow for all 6 funds, and then we're going to have to figure out how to get that to roll back to the model timeline, and then show like how the investor invests initially, gets some cash back, and then can reinvest in these future deals. And I guess the investment's going to be based on what you put into here. I don't know. It's going to be interesting to see what the aggregation of all of this looks like. But I'm excited to see it. All right, guys. I'll see you next Monday at 5 p.m. Eastern. Self